Today, let's talk about an industry-leading company that's been paying dividends for more than 160 years, Toronto Dominion Bank, ticker symbol TD. Anybody who was alive when TD Bank first started paying out a dividend has been dead for at least 50 years now, and over the last quarter century plus, the company has grown its dividend at an 11% annual clip. And as reliable as its dividend has been, there's more to Toronto Dominion than its 3.7% yield. TD is Canada's largest bank by assets, it's been identified as the safest bank in North America, and it's a major player in the discount brokerage industry. Oh, and it's established such a presence in the United States that it bills itself as America's most convenient bank. Hi everybody, Mike Nadell here for the Dividends and Income channel. Before I talk more about this outstanding business, please do us a favor to help us grow. Hit the thumbs up at the bottom of the video, subscribe to our channel, and ring the bell so you get notifications of new videos as we publish them. Okay, now let's talk about Toronto Dominion Bank's history, its business model, why we recently bought it as a long-term investment, and how it might appeal to dividend growth investors. TD's earliest predecessor, the Bank of Toronto, was founded in 1855 by a group of millers and merchants. In 1871, the Canadian Parliament gave a charter to the Dominion Bank. In 1897, the Dominion Bank became the first Canadian bank to go west when it opened a branch in Manitoba. 2 years later, the Bank of Toronto opened a branch in British Columbia. In 1911, the Dominion Bank started expanding internationally, first to London, a few years later to New York, and eventually to Asia. Despite the Great Depression and World War II, both banks expanded significantly over the next several decades. Recognizing that a union of equals would help them grow with the post-war economy, the Bank of Toronto and the Dominion Bank negotiated a merger, and the Toronto Dominion Bank was born in 1955. In 1964, TD Bank launched mutual funds. 4 years later, it came out with a Visa card known as ChargeX. The Toronto Dominion Tower opened in 1967 and was the tallest building in Canada at the time. In the 1980s, TD moved into the brokerage business by launching Green Line Investor Services. The bank bought New York-based Waterhouse Investor Services in 1996. 10 years later, the company merged its TD Waterhouse operations with TD Ameritrade, creating one of North America's largest discount brokers. In 2008, the company finalized its acquisition of Commerce Bancorp, a major northeastern U.S. bank chain that called itself America's most convenient bank. The operations were merged under the new brand name TD Bank, which decided to keep the Commerce tagline. In 2020, the Charles Schwab Corporation completed its $22 billion acquisition of TD Ameritrade. Under terms of the deal, Toronto Dominion became a 13.5% owner of Schwab, North America's third largest brokerage. Earlier this year, TD reached an agreement to acquire First Horizon, a Memphis-based bank that operates 412 branches and serves 1.1 million customers across 12 U.S. states. During the March 3rd quarterly earnings call, TD Bank CEO Bharat Masrani was very enthusiastic about the $13.4 billion all-cash deal for First Horizon. He said, "For years I've been saying that one of our goals is to expand in the fast-growing southeast of the United States. This week we delivered on that promise. Upon closing, we'll achieve leadership positions in key markets, strengthen our presence in states such as Florida and the Carolinas, and gain footholds in the large Georgia and Texas markets. This transaction is strategically compelling, financially attractive within our risk appetite, and culturally aligned. First Horizon is a terrific fit for TD and will enable us to further accelerate our growth in the U.S. The First Horizon acquisition and the stake in Schwab will only serve to bolster the bottom line of Toronto Dominion, which is already the largest bank in Canada by assets. TD has by far the largest U.S. presence of Canadian banks, getting about 33% of its revenue and 38% of its assets from the United States. It's also the number one credit card issuer among Canadian banks. It's second in market cap, second in business banking, and third in Canadian assets under management. Morningstar analyst Eric Compton is bullish on TD Bank's future, saying, "We like Toronto Dominion's positioning as a major discount brokerage player because we believe this industry is ripe for growth as investors seek out lower cost alternatives, and the bank could leverage its knowledge of the industry for future growth in Canada. Toronto Dominion should remain one of the dominant Canadian banks for years to come." Given that take from Morningstar, it's no surprise that they say TD Bank has a wide moat and exemplary capital management. They're top quality scores. TD also gets a sterling AA- credit rating from Standard & Poor's, high grades from Value Line for relative safety and financial strength, and a safe dividend score from Simply Safe Dividends. Late last year, online magazine Global Finance named TD Bank the safest bank in North America. Banks were selected through an evaluation of long-term foreign currency ratings from Moody's, Standard & Poor's, and Fitch. TD Bank's business operates under three segments: Canadian retail banking, U.S. retail banking, and wholesale banking. It has 2,214 retail locations in North America and 16 TD Securities offices worldwide. TD Bank's earnings have had about a 10% compound annual growth rate the last 5 years, topped by its best year ever in 2021 when it earned more than $14 billion in Canadian dollars. Now let's talk a little more about TD's reliable and increasing dividend, which the company's been paying for 165 years and which has had a compound annual growth rate of about 11% since 1995. You might have noticed that the data in that graphic is in Canadian dollars. Because of foreign exchange rates, there are times that Canadian companies raise their dividends in Canadian dollars, but the payouts actually decrease slightly in US dollars. But exchange rates fluctuate over time, and I don't worry about them when it comes to the dividend streaks of great Canadian companies. Rest assured, few companies anywhere have made the kind of long-term commitment to its dividend that Toronto Dominion has. After holding its dividend steady for 7 quarters during the worst of the COVID-19 pandemic, TD raised it by 12.7% last fall. At the current exchange rate, the annualized payout in US dollars is now about $2.84 for a yield of roughly 3.7%. The best way for US residents to avoid Canada's 15% withholding tax on dividends is to hold TD or any other Canadian stock in a tax-advantaged account like a Roth IRA, traditional IRA, or 401k plan. There, thanks to a so-called tax treaty between the US and Canada, there are no withholding taxes deducted. I own my TD shares within a Roth IRA. Now let's talk briefly about valuation. Many analysts think TD stock is attractively valued. The 11 analysts monitored by TipRanks say the stock is about a 13% upside. Saying there are positive trends in every category they measure, Forward Equity Research expects TD to outperform the market over the next 6 to 12 months. Schwab's analysts give TD Bank an A rating, meaning they expect it to strongly outperform the market over the next year. Morningstar's analysts consider the stock fairly valued, assigning a $76 estimate. Because investing is always about the future, I like to look at analysts' forecasts a few years down the line, as provided by Fast Graphs. The yellow highlighted area of that graphic shows that analysts expect TD's earnings to grow by 5% this year, 10% in 2023, and 18% in 2024. Meanwhile, the black box section indicates that if TD continues to grow earnings at a pace of its normal 10-year PE ratio, there would be an 11.5% annual rate return over the next 3 years. That's pretty darn good for a conservative investment like a Canadian bank. Because I think TD is a great business to own long-term that's trading at a fair price, I added it in March to my growth and income portfolio. I launched the GIP in June 2020 to eventually help pay some college expenses for our now 2.5-year-old grand twins, Logan and Jack. I've put at least $100 a month into the portfolio, which has grown to include 18 stocks. It was worth nearly $5,000 at the end of March, and its total return was 21.5%. Then when our other grandson, Owen, turned 1 last October, we started investing for him too. Because his father is Canadian and already owns a lot of high-growth American tech stocks, I decided to invest in dividend-paying Canadian stocks, and I started with the Bank of Nova Scotia. And now, after the March 12th birth of Owen's sister Piper, I've added $100 worth of Toronto Dominion. As wonderful as new investments are, they sure aren't as wonderful or adorable as new investees like Piper. For a look at the entire growth and income portfolio, check out the link in the description. In addition, I manage the Income Builder portfolio for this channel, and the link to the IBP's homepage is also in the description. Once on our Dividends and Income website, become a subscriber, you'll be notified whenever I write an article about my buys and sells. Alright guys, that's all for today. Again, please give us a thumbs up, subscribe, and ring that notification bell so you don't miss out on any of our content. Take it easy everybody. Back at you soon.